In this lesson, we are going to cover chapter 3, which is tax planning strategies. And this is the last chapter in our unit about the introduction to tax. So we just want to go over what are some different tax planning strategies. And you'll see that they focus on 3 main types of strategies in our text here. We have the timing strategy, the income shifting strategy, and the conversion strategy. So what do these concepts mean? So we will get into the timing strategy first. So this is going to talk about if we defer our tax, that should decrease our tax cost at the moment. And if we accelerate our deductions or take more deductions at the moment right now, that should also increase our tax savings. However, we know that the tax rate can change over time. You may be put into a different tax bracket depending on the amount of income that you're making, or sometimes the government just changes the tax rates. So you want to be aware of that when you are looking at the timing of when you want to take deductions and when you can defer taxes. So that's the first concept, is the timing strategy. The second one is the income shifting strategy. So this says that there are varied rates across different taxpayers and jurisdictions. So where you're taxed at. And so how do you want to determine where you're taxed at and who receives that income? How can we shift that income to different taxpayers or different jurisdictions to get that tax savings? So this will give you the IRS limitations, such as if you have a related party, someone that you're a relative to, there are some limitations there. And you can't just choose anywhere that you want to be taxed at. There are some rules to that as well. So what are the different income shifting strategies that you can take advantage of for taxes? And then the third one that we will go over is the conversion strategy. So this says that there are varied rates against different activities of taxation. However, sometimes there are going to be non-tax advantages and disadvantages as well. So you want to be careful of that. Even though there may be potential tax savings, it may not be as good as it seems. You've, I'm sure, heard the saying, sometimes things are too good to be true. So you need to pay attention to that when you're looking at the conversion strategy. So you'll see all of the different limitations that the IRS gives you, some judicial doctrine limitations, you'll get into that. And then we will look at the difference between tax avoidance, which is a legal concept, and tax evasion, which is not a legal concept. So this will be chapter 3. As always, if there are any questions, please reach out to your instructor and we will be happy to assist you. Have a great day.